Have you ever stopped to think about how companies really fund themselves? Day to day, I mean.
Yeah, it's not always the big stuff like bank loans or selling stock, is it?
Exactly. There's this huge kind of hidden source of short-term cash that's, well, it's part of almost every single business deal, and it's surprisingly strategic.
Hmm.
Today, we're doing a deep dive into accounts payable management. Now, for a lot of businesses, AP isn't just, paying the bills.
No, not at all.
It can be a real tactical tool. Often it's a major source of short-term financing, sometimes the main one, especially if getting a traditional loan is tough.
Absolutely. It's fundamental stuff for cash flow.
And if you're studying for the CPA exam, well, you definitely know this. It pops up in both BEC and FAR, right? It really underpins how businesses operate financially.
Yep, core material.
Before we dive deeper, a quick reminder that this podcast is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com. Whether you're an accounting student, CPA candidate, or professional, visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. Special thanks to Professor Farhat for providing this valuable material.
Good reminder. Lots of great resources there.
Okay, so our mission today, we want to pull back the curtain on this often underestimated part of finance.
Yeah, let's unpack it.
We'll look at what accounts payable actually is, how companies use it strategically, and uncover some pretty fascinating financial ideas and tricks that businesses use to handle their cash.
Sound good.
Sounds great. And what's really interesting right off the bat is how AP, this basic accounting liability, turns into, like you said, a major source of free short-term money.
Free money. How so? Well, think about it. It's basically an interest-free loan from your suppliers for, 30 days, 60 days, whatever the terms are.
Right.
That's where the whole cash management game really kicks off.
Okay, I see.
And, for anyone who's got that solid FAR background, the basic entry is simple, right? Debit an asset or expense, credit accounts payable. Easy enough.
Right, standard stuff.
But it's what happens after that entry. That's where the strategy comes in. And it shows why knowing your financial accounting cold is so crucial before you jump into the broader BEC topics.
That totally reframes it. It's not just, oh, I owe money. It's, okay, I have this financing tool. So once that payable is on the books, the clock's ticking.
Exactly.
And that's where it gets interesting, right? Especially when invoices show up with those trade discounts. You see terms like 210 net 30 or maybe a 310 net 30.
Very common.
So if you're trying to optimize cash, what should immediately flash in your mind when you see that?
Okay, yeah, that notation, it's huge for cash flow.
Yeah.
Let's break down 210 net 30. The 2% is your discount. Pay early, within the window, and you knock 2% off the bill.
Okay.
The 10 is that window, the discount period. You've got 10 days from the invoice date to pay and get that 2% off.
Got it.
And net 30, sometimes just N30, means the full amount, no discount, is due within 30 days. That's the total credit period they're giving you.
Right. So on the face of it, 2%, maybe 3%. It sounds kind of small, doesn't it?
It does seem small.
But if you connect that to the bigger picture, how much are companies really saving? Like if they consistently grab these discounts, what's the actual bottom line impact?
Now that's the critical question. And this is where we get into annualized savings. Super important concept, especially as you mentioned for the CPA exam.
Right.
Because while 2% seems tiny, when you annualize it, the effective interest rate you're basically saving by paying early, it could be shockingly high.
Okay. How do we figure that out?
Well, there's a standard formula. You take 360 days, sometimes 365, but 360 is often used for simplicity on exams.
Okay.
And you divide that by the difference between the full credit period and the discount period. So the number of days you're giving up by paying early.
Right.
Then you multiply that result by this fraction, the discount percentage over 100% minus the discount percentage.
Okay, walk me through the 210 net 30 again with that formula.
Sure. So first, the frequency part. How many times could this happen in a year? That's 360 days divided by first, 30 days minus 10 days.
So 360 divided by 20.
Right, which is 18. That 18 means you could potentially capture the saving 18 times a year if you're constantly buying under these terms.
Okay, 18 times, then what?
Then the rate part, that's the discount, 0.02 divided by 1 minus 0.02, which is 0.98. So 0.02 divided by 0.98.
Which is just slightly more than 2%, right?
Exactly, just a hair over 2%.
Yeah.
Now you multiply the two pieces, 18 times that number, that's just over 2%.
And that gives you...
Well, it works out to roughly 38% to 40% in annualized savings.
But hold on, a 2% discount, if you take it consistently, is like avoiding a cost of nearly 40% a year.
That's right.
Wow, okay, that's not small change. That's huge. That's the kind of return you dream about on investments.
Precisely. It really hammers home how powerful these seemingly tiny discounts are. It's like getting that interest-free loan plus a massive bonus just for paying a bit early.
Yeah, no kidding. That really changes the perspective.
And, for the exam, a quick mental shortcut is super useful. If you see a 1% discount, say a 110 net 30, using that same logic, 360/20 is 18, your annualized saving is going to be around 18% times 0.0101.99. So roughly 18%.
Ah, okay, so you can ballpark it.
Yeah, you can ballpark it really fast. See a 1% discount, think 18% annualized. See 2%, think close to double that, 36, 40%. It helps you eliminate wrong answers quickly on the exam. Saves valuable time.
That's a great tip. It's all about recognizing the true cost of not taking the discount.
Exactly. So stepping back, thinking strategically. From the company's side, the main goal with accounts payable management is almost always to, well, slow down payments, stretch them out as long as possible.
Makes sense. Keep the cash in your own account longer.
Right. The longer you hold on to your cash, the more you can do it and invest it short term, cover a payroll, just have a bigger safety cushion. Liquidity is king.
Absolutely. But how practical is that really, especially now with everything moving so fast electronically? And like historically, how did companies actually manage to slow things down? Were there some, I don't know, clever, maybe slightly dodgy tricks?
Well, you're right to ask about practicalities. And yes, historically, companies got pretty creative, though technology has changed the game quite a bit.
Okay, like what?
Well, the classic one was just using a physical check instead of wiring money. A paper check automatically builds in float time.
Ah, the float.
The gap between when you send the payment and when the money actually leaves your bank account. Mail time, processing time, it all adds up.
Okay.
Then there was geographical dispersal. This is pretty clever.
Yeah.
Say your supplier is in New York, but you cut and mail the check from your office in, like, Los Angeles
Why would you do that?
to take advantage of the banking system. Back then, checks cleared slower between different Federal Reserve districts. Mailing it across the country could add a few extra days of float.
Wow. Okay. That's gaming the system a bit.
Kinda, yeah. And some took it even further, mailing checks from really remote post offices just to add more mail transit time. You can almost picture them finding the slowest post office possible.
Like a financial scavenger hunt for delays?
Sort of. And a key part was often how the discount terms were read. Did the supplier have to receive the check by day 10 or just have it postmarked by day 10?
Ah, big difference.
Huge difference. If it was postmarked, you could mail it on the absolute last day of the discount period. From that far-off location, still get the discount, but the supplier wouldn't see the cash for maybe another week.
Man, talk about maximizing float.
Exactly. But, and this is important, a lot of these old-school float games are, well, they're much less relevant now.
Because of electronic payment.
Precisely. EFTs, ACH transfers.
Right.
They move money almost instantly. That float time basically disappears. So while companies definitely want to receive electronic payments quickly for their receivables,
Get the cash in.
fast, they might still strategically prefer to pay via check, if they can, just to hang on to that little bit of remaining float management. But it's shrinking.
Okay, so if the old tricks are fading, what are the sophisticated finance teams doing now? How do they manage disbursements and optimize cash in this, digital age? Surely they haven't given up on controlling outflow.
Oh, absolutely not. Treasury management today uses incredibly sophisticated banking tools. Two really common ones are zero balance accounts, or ZBAs, and controlled disbursement accounts.
Zero balance accounts, what are those?
Okay, ZBAs are pretty neat for managing liquidity. Imagine a company has its main bank account, right?
Yeah.
The central operating account.
Yeah.
Then they set up several sub-accounts linked to it. Maybe one just for paying suppliers, one for payroll, another for taxes, whatever they need. Here's the clever part. These sub-accounts are kept at a zero balance. Literally $0.
So how do they pay anything?
Money is transferred automatically from the main account into a sub-account. Only at the exact moment a check drawn on that sub-account is presented for payment, or an electronic payment needs to go out.
Ah, just-in-time funding for payments.
Exactly. The benefit is huge. You don't have idle cash sitting around in multiple accounts, maybe needing minimum balances. Almost all your liquid cash stays consolidated in that main account, earning interest or available for use until the very last second it's needed for a specific payment.
That's really smart. Minimizes idle cash.
Totally. And controlled disbursement accounts are similar in principle, often used for really big specific payments like major wire transfers.
How do they differ?
They're set up so the company gets notified early in the morning, say, of the total dollar amount of checks or payments that will clear against that account that day. Then they transfer only that exact amount needed from their main account to the disbursement account, just in time to cover those payments.
Again, keeping the money in the main pot as long as possible.
Precisely. It's all about minimizing idle cash and maximizing the time your funds are working for you in your primary account, fine-tuning cash flow down to the day, even the hour.
That level of detail is amazing. It really does sound like a finely tuned orchestra, like you said, making sure every dollar is playing its part right up until the performance. It shows just how strategic finance has become.
It really has. And, stepping back again, these AP strategies highlight this constant tension, this dual challenge in managing cash.
How so?
Well, accounts payable management, as we've seen, is all about slowing down cash outflow, delaying disbursements. But the flip side, accounts receivable management, definitely a topic for another deep dive.
Right, getting paid by your customers.
Yeah, that's all about speeding up cash inflow, getting paid as early as possible. So companies are constantly playing this balancing act. Slow down payments out, speed up payments in.
That's a great way to put it. A constant push and pull. So let's recap. We've really dug into accounts payable today.
We have.
We've seen it's not just bookkeeping, it's a critical, often free source of short-term cash. We've kind of demystified those trade discounts like 210 net 30 and seen the incredible power they have when you annualize them.
That 40% figure is hard to forget.
Right. And we've looked at how companies manage this from the old school check mailing tricks, exploiting float, to these really sophisticated modern banking tools like ZBAs and controlled disbursement. It's fascinating stuff.
It really is. And maybe a final thought to leave listeners with. Consider this. How might a company's choices in managing its AP actually tell you something deeper?
Like what?
Well, think about their financial health or maybe their attitude towards risk. A company that always takes the early payment discount probably signals strong liquidity, good cash flow, right?
Yeah, they can afford to pay it early.
Exactly. Whereas a company stretching payables to the absolute limit might be signaling tighter cash or maybe just a very aggressive cash management style. And maybe even think about how you could apply some of this thinking, this strategic timing, to your own finances.
Yeah.
Managing bills, credit cards, maybe not mailing checks from Alaska, but the principle of optimizing timing.
Huh. That's a great point, thinking about our own personal AP. Lots to chew on there.